Welcome to the Video CPA. Today we're going to be talking about part 3 of a 4-part series on rental property. Today we're talking about depreciation and amortization of rental property. And so let's go ahead and get into it. Many assets have a useful life of far more than a year and contribute benefits to the property. And so those under accounting theory and also tax theory need to be written off over a number of years, an estimated useful life instead of in the current period. And so those things are either depreciated or amortized. Depreciation actually refers to tangible assets, and in most cases amortization refers to the intangible assets. So that gives you an idea of what we're looking at here. So basically we're attempting to spread the cost of an asset over the useful life by expensing a portion each month or each financial period until that useful life is used up. The current useful life of your residential property, the structure, and we talked about basis in video part 2 of this series. So if you haven't learned how to build your basis, you need to go back and watch that video. But you'll take the basis of your property and divide for residential property by 27.5 years. That's the useful life of the residential property. The useful life of the commercial property right now is 39 years. Now, this is one area there's not an exception to, but there are exceptions for almost everything else that I'm going to talk about, and that's what makes depreciation very, very difficult in some ways. The useful life of the tangible personal assets that are included in rental property, like appliances, refrigerators, washers and dryers, that type of thing. Even the carpet, which you wouldn't think of as a personal tangible asset, but those things are depreciated over 5 years using a half-year convention. Now, conventions basically tell you how much depreciation you can use during the first year and how much depreciation you can use during the final year that you own the property. Your structures of your rental and commercial properties have to be depreciated using a mid-month convention, so you need to be aware of that. Let me take a minute and talk about improvements to either the commercial or the residential property. Your improvements are going to be written off over the remaining life of the underlying property. So if it's a commercial property and you've got 36 years left, you're going to have to take that improvement over 36 years. Residential property, for example, with 20 years left, you'd take it over 20 years. And that's the way the improvements are depreciated. But with commercial property, there are exceptions to this, and there's exceptions almost to everything that we're doing here, especially on commercial property. And we'll get into that in a few minutes. Before I get into depreciation methods, let's talk about when a property can start being depreciated. And that's not exactly when you purchase it. It's on the placed in service date, which may be different than when you actually purchase the property. Let me give you an example of that. I mean, if you buy an appliance for a rental property and you buy that appliance in 2019, but the appliance isn't delivered and put into the rental property until 2020, your depreciation is going to have to start in 2020 and not in 2019 when you purchase the property. So you need to be aware of your placed in service dates and make sure you're doing that properly. Your main structure on rental property, either residential or commercial, is going to be depreciated, like I say, for residential over 27.5 years and for commercial over 39 years. Now, it is possible to have what's called a cost segregation study and break some of the elements down within that structure. And if that's the case, those studies are very expensive, but you could depreciate possibly some of the components of that building, like the fire system and the roof possibly, the heating and cooling system, over a different method with a shorter useful life. With that said, let's go into depreciation methods for real estate. Your rental property is and your commercial property, the structures are going to be depreciated on a straight line basis. So that's very simple. You take the basis, what we talked about in part 2 of this series, and divide it by the useful life. So with rental property, it's divided by 27.5 years. Commercial property, it would be divided by 39 years. The only other thing that you have to take into account is the mid-month convention, so that if you're doing that manually, it's pretty difficult, but if you've got tax software that calculates depreciation, it becomes pretty easy, but you do have to simplify. It's a mid-month convention. The tangible personal property that's within the rental, such as furniture and appliances, as I mentioned earlier, will be depreciated over a 5-year period. The depreciation method for those is 200% declining balance. So if you've got a tax book, it may give you a table that shows you for each year what percentage you should take, or you can actually calculate it manually. But so you'd have the cost of that asset multiplied by the percent depreciation factor for that particular year to yield what the depreciation is that you should write off in that period. If you have improvements to the property, those will be written off, like I mentioned earlier, depending on the underlying basis that's left on that, or the underlying life that's left on that property. Those will be written off on a straight line basis. And again, if you've got intangible assets, those are also written off on a straight line basis. And those intangible assets on rental property are generally, as we talked about last time, the items that are related to the loan. Another option related to the depreciation of rental property is the Section 179 deduction, and you may have heard this in relation to other types of property as well. This deduction does not refer to residential real estate or the structure of the building, but it does refer to tangible personal property that is within the building. So ranges, refrigerators, furniture used in connection with lodging, that type of thing. Section 179 basically says that these things can be written off in the year placed in service. And Section 179 says that you can write off a little bit more in 2019 than $1 million, which usually isn't the case, or certainly not needed in small rental activities. But so just be aware that your tangible personal property can be written off. That's for residential property and for commercial property. Now, commercial property also contains another option for Section 179, and that is that improvements to non-residential property, including roofs and HVAC systems, fire protection, alarm systems, and security systems, can be written off in the year placed in service. 179 expensing of these type of properties would require, as mentioned earlier, cost segregation study that can be pretty expensive. But if you have those and the cost is segregated, those can be written off possibly over a lesser time than 39 years. Another exception that you need to know about for depreciation, and specifically Section 179, is what's called qualified improvement property. And these are improvements to the interior of a building, not the interior structure, but the interior of a building. They do not include expenditures for elevators or escalators or enlargement of the building or the internal structural framework of the building, but they're for just improvements of the inside of the building. And these can be taken on 179 for commercial property only, not for residential property. Now, the depreciation of qualified improvement property is a little bit up in the air. When the committee actually wrote up the law and it was passed, they had mentioned that this would be 15-year property with a half-year convention. But in the final regulations and legislation, that was not mentioned. So right now we are stuck on qualified improvement property with a 39-year period and mid-month convention. Three other items that need to be mentioned about Section 179 is that if you elect 179 on an appliance, for example, and you don't keep that appliance for 5 years, for example, you sell it after 2 years, there's going to be recapture on that appliance, which means you're going to have to pay back some of the 179 allowance that you have taken. And that's called recapture. There's also an income limit on it, which means if you're not making any money, you're not going to be allowed to take Section 179. So be aware of that as well. And then there's also a carryover on it. If you can't apply all your 179 deduction in a given year, well, that amount will be carried over to future years. So keep those things in mind when you're electing to take Section 179 deductions. Another exception in the depreciation area is called bonus depreciation or the special depreciation allowance. That allows you on tangible personal property. It's not can't be used for real property, but it relates to both residential and commercial, and it also relates to new or used property that you've installed in your rentals. What that basically says is you can write off 100% of the expense of those, the cost of those, in the year placed in service. Now, 100% has changed in the past, so currently it's 100%, but it's gone in the past from 30 to 50%, so that could change in the future, but right now it is 100%. Let's discuss what's called the de minimis safe harbor election. In the past, there were always questions by tax preparers as to what the threshold was for capitalization. For example, if you have an asset that cost $500, were you required to capitalize that by the IRS and depreciate it, or could you expense it in the period? Well, the de minimis safe harbor election has cleared that up a little bit, and basically what it says is if you can spend on rental property up to $2,500 a year. That includes improvements. It also includes personal tangible property. Now let me add right here that the de minimis safe harbor election is not just for rental property. We are talking about it in connection with rental property, but it also pertains to other things as well. And the $2,500 is on an invoice basis, so you can buy an item for $2,500 and then buy another item for a little bit less than $2,500 and expense both those items. Now, there is one exception to the $2,500 write-off rule under the de minimis safe harbor election, and that is if you're a taxpayer that has an applicable financial statement, which means it's required by the SEC and it's been audited by a CPA, you can actually write off up to $5,000 per item under that election. $5,000 is basically designed for larger taxpayers, and I would think that very few of you listening to this YouTube video would apply under the $5,000. You're going to apply under the $2,500 write-off. Now, the de minimis safe harbor election has to be elected annually, and it's elected by filing a statement with your tax return. Under the proper section, you have to title it the de minimis safe harbor election and state the section. So once you do it, it's irrevocable. An additional election for those who own rental property is called the small taxpayer safe harbor election. And that is for small taxpayers, meaning under $10 million. So I'm sure most of you will feel this is applicable to you. Now, basically what this says is that you can write off in any 1 year, and you do have to elect this on an annual basis. And the election, again, is on the bottom of this slide. You can write off the lesser of $10,000 per year, or 2% of the unadjusted basis of the property. And the unadjusted basis of the property is basically the basis that we came up with in part 2 of this series. So it's the basis without having taken any accumulated depreciation off of it. This applies to properties that are $1 million or less, so you're not going to be able to write off much on a big building. This is smaller apartment buildings and rental type situations. In conclusion, thank you for listening. Be aware that this video only covers the basics of rental property. There are a lot of other exceptions and stuff that I haven't mentioned in this video, so be aware of that. If you've got one single rental property or maybe two residential rentals, you're going to be in good shape with this video. But if you've got commercial property, especially large commercial property, there's a lot of other options that you should be aware of that are beyond the scope of this video. Appreciate you all for listening. Like I said, my next video is going to discuss the sales of rental property and how you calculate gain or loss. So please tune in, like this video, subscribe to the channel, and if you're so inclined, and stay safe with coronavirus out there. Good living until next time.